Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today in episode 334, we're going to talk about the bucket strategy. I alluded to this in the last episode when I was describing my new note-taking method. And part of that note-taking method is sort of taking a deep dive into the bucket strategy. Frankly, I'm not done with that deep dive. There's a lot more reading on the bucket strategy that I want to do. But I thought in today's episode, I would share with you kind of what I've learned so far and my current thoughts on the bucket strategy. So let's begin with what it is and why it is, I suppose. It's a simple, I suppose, way to think about how you manage your investments when you're in retirement. So before retirement, we always, I think of asset allocation in terms of percentages. So you might, for example, have 80% of your investments in stock funds and 20% in bonds, for example. The challenge when you get to retirement, of course, is that you need to start spending some of that money. And that raises the question, well, how do you manage that spending? And each year, where do you take your money from? For example, what if we had another 2008, 2009, where stocks are down 50%? I mean, we've always been told we don't want to sell stocks in a down market, but I mean, if in retirement you need to live, you need to pay your bills, and so couldn't we possibly be forced to sell stocks in a down market in order to fund our retirement? And I think it was that concern that led to what we call the bucket strategy. And the idea was this: we're going to have some buckets of cash that we can use to fund our retirement for some period of time, so that when we have a down market like 08 and 09, we have this buffer, if you will, so that we don't have to sell stocks to live on. That's sort of the theory. How's it actually implemented in practice? Well, there's no one way to implement the bucket strategy, but I think a standard approach would either be 2 buckets or 3 buckets. And I'm going to sort of describe the 3-bucket approach. And again, these are not set in stone. There's no one, just like asset allocation, there's no one right asset allocation. Well, there's no one right bucket strategy. But this is one that I've read a lot about and seen a lot. And it's so you'd have 3 buckets. Bucket 1 would be your cash bucket, and you'd have, let's say, 2 years worth of living expenses. So let's assume, just to make the math easy, you were going to live on $50,000 a year out of your investments. So you'd have $100,000 in a cash bucket, in your checking account, maybe a savings account. Then you'd have bucket 2, and it would be bonds, typically some fixed income investments that will produce some interest, but aren't that volatile. And I've seen a lot of folks say 5 years. So you've got 2 years in cash, bucket 1, 5 years in bonds in bucket 2, and then whatever you have left is in bucket 3, and that's in stocks. And so the idea is, if your bucket 3 takes a beating in a bad year, it's okay, just leave it alone. You've got 2 years in bucket 1, you got 5 years in bucket 2, probably based on historical data, more than enough time to weather a bear market, certainly to weather something like 08, 09. And once the stocks recover, then you can take money out of bucket 3. So that's sort of the idea behind the bucket strategy. And I think there's some appeal to it. I mean, it's simple, that's good. And it does, at least on the surface, create this buffer so that if stocks are down, we don't want to sell. When stocks are down, we've got a pretty good buffer of cash and bonds to cover us. So that's on the surface. There's one thing that's always bothered me about the bucket rule, and I've never found a good answer to it. And it's this: while I understand the concept in theory, we don't eat theory. We can't live on theory. How do we know when to refill the buckets? If stocks are down and you don't want to take anything out of bucket 3, okay. But when is it safe to start taking things out of bucket 3? Do you wait until stocks are back up to whatever the peak was before the last bear market? Or maybe you don't take money out of bucket 3 if stocks are down for the year, but if they're up next year, even if maybe they're not back up to where they were, but if they're just up next year, maybe then it's safe to take money out of bucket 3. No one's ever been able to give, at least to my satisfaction, an answer to that question. When do you refill? If you simply refill every single year, I kind of think of it as sort of a waterfall. Bucket 3 is at the top with your stocks. It pours into bucket 2 with your bonds. That pours into bucket 1 with your cash. If you refill every year, well, you're effectively just taking money out of stocks every year, right? So, and isn't the whole bucket strategy to avoid that in a down market? So that was the first question that I had. And one, again, at least so far with everything I've read, I've not gotten a good answer to that. Now, by the way, some will come up with rules, right? They'll say, well, if stocks are down, you don't take it out of bucket 3. And if the following year they're up, then you do. I'm not sure how sound that strategy is. I mean, I guess it's simple, but it doesn't really make a whole lot of sense to me, particularly when you get to the second issue that I have with the bucket strategy, and that is, if we think about the 4% rule, asset allocation matters. I mean, Bingen found that if you're in the range of 50 to 75% in stocks and the rest in bonds, the 4% rule will work. If you have more than 75% in stocks or less than 50% in stocks, your failure rate goes up. Now, it doesn't mean that the portfolio will necessarily be exhausted before the end of a traditional retirement, but it could be, and the odds of it being exhausted too soon go up. And the bucket strategy doesn't really address that issue. There's no point in there where it says, well, wait a minute, we also have to figure out and think about your overall asset allocation before we start, moving money around in the different buckets. The third issue I have is that when stocks are down, what should we be doing? Yes, we shouldn't be selling, but it's more than that, right? We should be taking money out of our bonds and buying the stocks, right? That's what we do every year when we rebalance. If we have a 50-50 portfolio and stocks have a bad year such that at the end of the year we're at 55% bonds and 45% stocks, we rebalance. We sell high, we sell the bonds, and we buy low. We invest them in stocks to get our allocation back. I'm just using 50-50 as an example. Yours might be 80-20, whatever. That's sort of the purpose of rebalancing. And in the case of the bucket strategy, that seems to be nowhere in the consideration. So those were my concerns with the bucket strategy. And I started down a path of trying to analyze the bucket strategy, read about it, and it turns out other people have the exact same concern as I do. Now, one potential solution I've seen is the idea that we'll first fill bucket 1, the cash bucket, with interest and dividends, right? They're getting paid out from bonds and stocks anyway, whether that's bonds in bucket 2 or dividends in bucket, interest in bucket 2 or dividends in bucket 3. We can just flow those right into the cash bucket. Well, okay, that has some initial appeal as well, but if you give it second thought, there's immediate problems with that. First of all, to the extent they're in retirement accounts, you may or may not want to take them out of those retirement accounts, depending on what kind they are, either because they're tax deferred and they'll trigger taxes that you may not want to trigger, or because they're in Roth accounts and you'd rather hold off on spending your tax-free money, which is not always the best answer, but certainly when you think about the order in which you take money out, many suggest that tax-free accounts like Roths should come at the end. So there could be tax reasons why you might not want to take dividends and interest and stick them in your cash bucket to spend. That's one thing. The second thing is that the amount of dividends and interest is pretty arbitrary. I mean, at least we don't have control over it. At least not really. I suppose we can pick what kind of investments we give our money to, but we don't have control over how much in dividends Tim Cook and the board decide to pay out at Apple. And so, there's that problem. Should we really turn over to the whims of corporate America and the bond funds as to how much we're going to move into the cash bucket? And as people point out with this strategy, for most folks, it won't be enough anyway to totally fill up the cash bucket with what you need. And so while moving the dividends and interest to the cash bucket has an initial appeal, I think on closer examination, it really doesn't solve our problems. And all of which gets to the point that you may be asking now, and that is, okay, well, Rob, what's the answer to this? Well, I've kind of come full circle. I think the answer is, more or less, with one exception that I'll talk about in a minute, to basically kick the bucket strategy down the road and just go back to our sort of total return asset allocation. And here's my thinking. Let's imagine in retirement, we know we want, if we're following the 4% rule and Benjamin's analysis, somewhere between 50 and 75% in stocks. So let's imagine for our hypothetical retiree, we've decided on 60-40. 60% stocks, 40% bonds. Now, the first question is, well, how do we tap that to spend money? Well, it doesn't matter. It matters from a tax perspective, where you're going to pull the money from, no question. But I'm not talking about taxes today. I'm talking about asset allocation. Here's why. Let's imagine we're going to rebalance once a year. Regardless of whether you take your year's worth of spending out of bonds or stocks, as soon as you do and then you rebalance, the outcome is going to be the same. You're going to be at 60% stocks, 40% bonds. It doesn't matter if you've taken your year's worth of spending out of stocks and then rebalanced, or you've taken it out of bonds and then rebalanced. The result is going to be the same: 60% stocks, 40% bonds. And if you think about the bucket strategy from a spending perspective, I think it's absolutely appropriate and sensible when you think about your bond allocation to include in that the cash you'll need over the next year or two. So for example, again, using 60% stocks, 40% bonds, the 40% in bonds might include some cash. That's okay. We're talking about safe fixed income investments. So, and you might think of that sliver of your bond portfolio in terms of years worth of expenses. So for example, again, just to make the math easy, if we have $1 million portfolio, that means we're going to have $400,000 in bonds. And if we're using the 4% rule, we're going to take out 40 grand in year one and then adjust it for inflation. So it's perfectly fine to say, of that 400 grand in bonds, I'm going to keep 40,000 of it or 80,000 of it for 2 years in cash. I think that's perfectly fine and sensible and probably what I would do. I mean, you've got to sort of manage the day-to-day of spending. You don't have to do it that way, right? You could make a withdrawal from the account every month and take it out of a bond fund or a stock fund for that matter. But it seems to me having that in cash makes sense. I would probably, for me, pull it out of my brokerage account, right? I'd probably keep a year's worth of expenses in my checking account and maybe a year's worth in my savings account. But I would view that as part of my bond portfolio. And I'd have a 60-40 allocation. Now, what happens at the end of the year? We've spent $40,000. So our cash portion is cut in half. But what's our allocation? That's really what matters, at least initially. Well, it was 60-40, including the cash, right? It was 60-40 at the beginning of the year. We've spent $40,000 in cash, but of course, market values will no doubt have changed. Stocks will have gone up or down. We will have earned dividends in the account. Bonds values will go up or down depending primarily on what interest rates do, unless you're in high yield bonds, and then it could depend on the economy. But bonds will go up and down. You will have earned interest. And so when you look at your allocation at the end of the year, who knows if it's 60-40? Unless the year has been a really extreme one, it's probably going to be somewhat close. And so what do? Well, you just rebalance. If stocks are down, in the bucket strategy, you would just sort of ignore that bucket. But in the basic asset allocation that we all know and love, you're not going to ignore your allocation to equities. They're down. You're going to rebalance, which means you're going to sell some bonds, buy some stocks, and you're going to get back to your 60-40. If the reverse is true, maybe stocks are up but bonds were down, you're going to, again, sell high, right? You're going to sell some stocks, rebalance into your bonds, and back to a 60-40 allocation. And if you're following the bucket strategy only for your cash, you're going to take whatever is allocated in your bonds and make sure that 80,000 of it's in cash. So we already had 40,000 left over. Remember, we started with 2 years of cash at the beginning of the year. We spent 1 year of it. So, we might end up taking part of that 40% in bonds, selling $40,000 worth of bonds and putting it in cash, just to keep 2 years worth of cash, if that's what you decide. That kind of seems sensible to me, in cash. But you've still, big picture, have a 60-40 allocation. The reason I like this so much better than any sort of bucket approach is that, one, it keeps you focused on your overall asset allocation, which we must always keep in mind. It's a critical part of the 4% rule. So we've always got to keep that in mind. It's very easy to implement. I can take at least as much as I can, my emotions out of it. It's very black and white. I rebalance once a year. I get back to whatever my allocation is, 60-40 in our hypothetical. Of the 40%, I include 2 years worth of cash. Fine, it's easy to do. Still got my 60-40 allocation. And so it's very simple. Now, there are some variances. You could, for example, say, I'm going to go 60-40, but I'm not going to, in that analysis, I'm not going to include cash. Cash is separate. I got 2 years worth of cash. And then whatever I have left gets split up 60-40. Now, the net result of that is your overall allocation isn't quite 60-40, right? It's going to be whatever, 55-45 when you add the cash. But that's okay. I mean, as long as you get to the overall allocation you want, if it helps you to think about your cash as separate from your stock bond portfolio, that's fine. And in fact, you could even think of that from the perspective of a bucket strategy, right? Because what you could say is, I've got 2 years worth of cash in bucket one. Bucket two is bonds. Bucket three is stocks. And I'm going to adjust those two buckets based on percentages. So bucket two is always going to be 40% of whatever's in bucket two and three together. And bucket three is going to be 60%. So I've got my 40-60 or 60-40 allocation between buckets two and three. I keep my cash separate. That's a bucket strategy. I guess we could call it a bucket strategy. I mean, really, it's no different than your basic asset allocation in percentages. I think where things start to break down with the bucket strategy is when we start to think of bucket two in terms of years of expenses. And that's normally how it's thought of. That's when things start to get, I think, a bit hairy, and how to go from bucket three to bucket two and when. There are decision rules. I've read complicated papers on this with math formulas that, frankly, I don't fully understand. The upshot to all of them are, that's probably just not worth the complication. Just go with your basic total return asset allocation. If you want to have a bucket one that's separate and apart with cash, fine, not a problem. And then between buckets two and three, if that's how you want to think about it, just implement your asset allocation. Think of it, though, in terms of percentages of your total investments, not in terms of years worth of living expenses. That makes sense for cash. Probably just complicates unnecessarily the whole situation when you're going to your stocks and your bonds. So that's my current thinking on the bucket strategy. I'm basically kind of throwing it out the window. Now, as I said at the top of the show, I'm still doing a lot of reading on it, and I'm planning to do some writing on the bucket strategy. I always want to keep an open mind, and so a lot has been written on the bucket strategy, but everything I've read, both those that promote the strategy, those who are not so fond of it, I come to believe that the bucket strategy, as described by most, is of limited value. I think, again, it can help on the cash side of things. It can also help if just in your mind, it's just an easier way to understand what's going on, and that's fine. But I think it's a mistake to think of anything beyond bucket one in terms of years worth of expenses. Bucket one, fine. Buckets two, three, whatever, however you're going to divide that up, I think it needs to be an asset allocation framework based on percentages and thinking of it in terms of total return, not trying to move from one bucket to another based on how much the S&P 500 index fund paid in dividends that year. The other thing that I didn't touch on, I alluded to it, didn't touch on it, but is taxes. I think the asset allocation plan, where you're thinking of it in terms of percentages, is going to be much easier to implement in terms of taxes as well. Again, for reasons that I mentioned, you start to try to move dividends and interest from one bucket to the next and down eventually to your cash account, say in a checking account. That could trigger all kinds of taxes and that you're just not wanting to trigger. But when you come to a percentage basis, you still got to deal with the taxes. You still got to know which accounts you're going to pull your money from. An important topic, but a different one. And in fact, maybe I'll cover that in an upcoming episode. But I think it's much, much easier to implement when you think of your asset allocation in terms of percentages and total returns. So there you go. That's my current take on the bucket strategy. A bit different. I was kind of in favor of it, although that nagging issue of how you go from bucket 3 to 2 and when, and bucket 2 to 1, it's an unnecessary complication in my view. Would love to hear what you think. Shoot me an email, rob@robberger.com, or comment in the Door Roller Facebook group, doorroller.net/Facebook group. Would love to hear from you. Love to get your thoughts on this. And until next time, remember, the best thing money can buy is financial freedom.